Okay. Should funds be put in trust now or later after the parent's death?
That depends on the parent's financial situation, and it depends on what it is that the beneficiary needs. Most times, we're funding that trust primarily after the parent's death. And part of that is tax planning. When you transfer assets to a special needs trust, they don't qualify for the annual exclusion for gift tax purposes. So where you might be able to give $13,000 to each of your other kids to reduce the size of your estate, when you give that $13,000 to the disabled child through the mechanism of a special needs trust, that doesn't qualify for the annual exclusion, so you are going to use up your exemption as you're making those transfers. So it can get to be, for small gifts, you know, like you're doing for your other kids, usually it doesn't make sense. Sometimes it'll make sense, though, to make the gifts during the parent's lifetime. For example, if there's going to be a house purchased for the child, and you can do it without a mortgage, because if you're going to need to get a mortgage, you're going to have a hard time doing it in the trust.
Right.
I just spent 2 hours counseling a client on this issue. There's been a housing problem. Their son's not functioning very well in the group home, and they want to buy a small condo for him and have a live-in caretaker, and it makes beautiful sense, and the numbers work. The problem is they don't have the liquidity in their own estate to be able to fully purchase this home, and so they would have to have a mortgage to do that. Well, the lenders don't like to give out loans to trustees of irrevocable trusts. So then you end up, if you can even get a loan, you have a very high rate. So you end up having huge expenses in order to get it to work. But if you can buy the house outright, then it can be a very good thing to get done, especially now while you've got deflated housing values. You're making a gift, get it out of your estate, get it there for the beneficiary. It stays in the trust where it's protected.
Yeah. So another thing that we can point out, right, at least for right now, is we have some pretty large exemptions that are available. Now just for 2011 and 2012, and then it's unknown what's going to happen beyond that. But,
Correct.
But actually we have I guess what we call it, a unified exemption. In other words, it applies for both your gifts and your estate transfers, a total of $5 million per
Correct.
parent.
Correct.
And so actually we may have some opportunities for people to put some large gifts, use some large gifts for this year, next year.
Absolutely,
Yeah.
Absolutely. It's a good time to be considering it, which is why I had this 2-hour meeting with this woman. Another, we talked a little bit about, do you put the funds in now or later, and do you set the trust up as part of your estate plan, or do you set it up as a separate plan? Another issue to consider is, unfortunately, the statistics show that parents of disabled children have a much higher divorce rate than even the general divorce rate. It's very, very difficult to raise a disabled child. So very often you do have parents who are divorced. Now, that being the case, you have two separate parents who are going to probably be contributing funds for the care of this child when they pass away. And in that situation, you really do want to have a standalone trust. It's great. I've done a number of these where I meet with the parents and they work together to draft the trust and select who is going to be the trustee, whether it's the surviving parent or if it's going to be a private professional fiduciary, that kind of thing. It's a really fabulous opportunity for the divorced parents to get together to work through some long-term planning for how to take care of this child and to really look at how they can maximize their personal wealth opportunities to provide for that disabled child.
Okay. So, since you brought in the thing of two parents, what about grandparents? What about anybody else that wants to contribute to a trust like this, can they do that?
Again, if I set up the trust as part of your estate plan, your own living trust, it does not exist until your death. So if there are other people who want to contribute to the disabled child, the best thing to do is have that special needs trust set up separately in advance so that the grandparents can make their bequest into the special needs trust. We don't want anything going outright to the child. If it goes outright to the child, we have to go back to that other type of trust that we talked about with the litigation trust, the D4A trust. That trust says that if there's any money left, it goes to the government at the end. And I promise you that the grandparents, when they were leaving that $100,000, wanted it to take care of the child, and if there's anything left, to go to the other family members, not kick back to the government. The only time it kicks back to the government is if it was the beneficiary's own assets. So if they actually inherited them or received them as a settlement, or if we're doing planning for somebody who's become incapacitated and they're putting their own assets in, that's when the government can come back after death and claim the balance of those funds. If it's mom and dad left money, gift or inheritance, grandparents left it gift or inheritance, the government has no access to it. They don't get to get reimbursed for services. So it's very, very important. And in fact, there's been some legislation going back and forth on the table up in Sacramento about expanding the scope of what the state can get reimbursed for, and they're now trying to add regional center services to what can be reimbursed for. They're also looking at making regional center a needs-based not facility, organization or department also. So it's so very, very important if you have a disabled person in your family to really take care of getting these things set up. I mean, even if it's $50,000, and I've set up trust for $50,000 because it makes a difference in that person's life. It allows them to get an extra pair of glasses when they need it. It allows them to see a specialist outside of the doctors who will take Medi-Cal patients. It allows them to get orthotics for their shoes, all sorts of things that they can't get covered because, of course, Medi-Cal is very limited in what it can pay for, and it's going to be more limited as we move forward with these huge deficits that we have, both at the state and the federal level.
Okay. Now we said a regional center. Would that, for example, be like Valley Medical Center here in?
Oh no, I'm sorry. I'm talking about the regional center services for disabled persons. Somebody who has been determined to be disabled before the age of 18, they qualify for regional center services.
Oh, okay. So it's a special, like, state service center.
Correct.
Okay. All right. Well, what happens if the parent dies without setting up one of these trusts? Then what do they do?
Then it's very, very, very expensive compared to how much it would have cost to the parent to set it up during their lifetime, because we basically almost always have to go to court for authority to set up this trust, to take the funds and put them in a special needs trust so that the beneficiary can still get their public benefits and those aren't interrupted. And then if there are any funds left at death, again, they don't come back to the family, they go back to pay the government for the services that have been provided. So we can come in after the fact. If the parents have not set things up properly, and it happens a lot, people don't know it. This is a sophisticated concept. And if somebody is just, doing a holographic or a handwritten will, or doesn't go and see an attorney, tries to do their own trust with something online, they're not going to know about this.
Yeah, until it's family lawyer software.
Exactly, they're not going to know about this. But the good news is we can take care of it after death. The bad news is it's going to cost a lot more in legal fees, and you're going to lose more money to the state of California than you would have been able to protect for the family. So really worth your while to spend some money now. If you have the liquidity to spend the money to do it now, Get it set up in advance, because there will be more in the end for your disabled child, and that's usually what the parents want, is to do what they can for their disabled child.
Mm-hmm. Okay. We've got about 2 minutes left, so maybe I'll let you just throw out maybe a final thought related to this as we wind this thing up.
Trustees. I really want to talk about trustees.
Okay. Very briefly.
Choice of trustees, briefly. You know I can't do briefly.
Do the best
Choice of trustee is so important. Most people, their gut reaction is to name a child, a sibling, as the trustee. Very, very strongly urge my clients to find an alternative besides the sibling. It complicates the relationship between the siblings, and the sibling can be resentful. There can be a lot of power struggles and power dynamics that would not be going on otherwise. With my clients, if they absolutely cannot come up with somebody else and they insist on naming the child, I am usually successful in talking them into adding a provision that says that the child that they've named as the trustee has authority to designate a successor trustee, who could be a bank or a private professional or another person outside of the family. Let the siblings be siblings. Mm-hmm. Don't mix the money up. Don't give the child, the well sibling, the power over the ill sibling. It can be very, very complicated and difficult.
Yeah. So I've talked on the show before about the professional fiduciaries, and so I think that may be a really good choice if you've got enough funds. You know, if you're talking about the $50,000 trust, there just isn't going to be enough there to support it.
You know, I have private professionals serving as trustees on tiny trusts, and it's because we have business back and forth where there's large pieces and there's small pieces. And if there's a small trust and we know that we've got a fairly easy flow, it can be managed, and it can save the relationship between the siblings.
Okay. Folks, we're done. Thank you for joining us today. Hope we'll see you next time on Financial Insider Weekly.